Hi everybody, welcome back to another video. In this current market, the three SG banks, DBS, UOB and OCBC still seems to be the most attractive to buy in terms of dividends. What is the main reason is because with the interest rate having the possibility of staying higher for longer, banks will definitely benefit from this. So in this video, we'll go through the recent OCBC and UOB earnings and DBS amazing earnings call insight that actually shocked me. At the respective bank share prices and the expected dividend yield, you can see that for DBS is much higher at 7.17%. However, things to take note is that I'm assuming that there will be a bonus dividend of $40 at the end of the year. So we'll see what happens. Of course, even without this bonus dividend, it's still at a very attractive yield of 6%. Similarly, for OCBC and UOB, they are also near the range of 6% dividend yield. Let us dive right into UOB's Q1 earning results. UOB Q1 earning result was quite decent. Similarly, for all banks, the net interest, which is the interest payment they earn from loaning out their money, is the bulk of their income. Like DBS, UOB managed to maintain the net interest margin but came in slightly lower due to shorter quarter. Therefore, the net interest income dropped 2% quarter over quarter, which is a small issue. Like I said in my previous video here, non-interest income is the driving factor that I hope to see for UOB. DBS is already seeing the effect with the huge growth in the treasury fee. UOB also had very good growth, with other non-interest income skyrocketing by 32%, while the non-interest income increased by only 2% Q over Q. However, I hope to see the non-interest income increase much more considering the business they have bought from Citibank. And these sectors of income will tend to be more stable as compared to trading income under the other non-interest income. Because of this huge bump, the ROE for UOB has increased by 0.2% Q over Q to 14%. Even though it's lower than DBS ROE, but it's still quite decent for normal banks. The cost to income ratio came down with lower expenses and higher income, which is good to see for shareholders. Their non-performing assets and allowances are not increasing as well. This is good because this meant that the loan lenders are still able to pay the interest of the debts that they are loaning from UOB. CET1 ratio is another important metric which determines the bank's liquidity in the balances. And you see from the past few quarters, it has been on a rise back to 13.9%. And this is decent considering even after giving the dividends, the CET1 ratio is still able to go up. It shows how much money that they are accumulating with the increase in their income. For UOB's outlook, it seems bright with the management still forecasting double-digit growth in fees while single-digit growth in loans. This might be one of the main reasons why it caused the stock price to recover. They have also fully integrated their Malaysia, Indonesia and Thailand business acquired from Citi. Their digitalization, similar to OCBC and DBS, is something to look at, as digitalization not only optimizes their ROE, but it also provides convenience for more funds to enter the bank. I also have been using their app since I got the UOB KrisFlyer credit card, and the app is very seamless. If you are looking for any credit cards, you can look into my referral links with SingSaver for good promotions. Currently, they have an event not only if you can earn credit card rewards, you can also top up cash for even better rewards, or stand a chance to win grand prizes from the Team Cashback vs Team Miles event. To join the event, you must click on the links below for the credit card referral and apply. Now let's continue with the next analysis, and that is OCBC. OCBC's Q1 results was very good. What's the biggest factor? It was their 47% increase in quarter over quarter on their non-interest income. Later we will see into the reason for this huge jump. The return on equity, which is one of the most important parameters for earnings of banks, came in at 14.7%, which is very good for banks. UOB was the lowest at 14% compared to OCBC at 14.7%, while DBS is at 19%. Thanks to the jump in the income and the return on equity, the earnings per share, which is the EPS, came in at 24% higher quarter over quarter at $1.76. So if we look at their balance sheet, similar to the other two banks, net interest income had no change while the non-interest income increased, therefore allowing the total income to increase by 11% quarter over quarter. If we look at the wealth management slides, the increase in the wealth management income by 33% quarter over quarter was due to the strong performance from insurance business. In my previous video, when I analysed on the earnings call, the management have also mentioned that for insurance business, sometimes the profitability might be unstable. Therefore, for Q4 that quarter, it had a dip to 88 million, whereas for this quarter, it have recovered back to 289 million. The wealth management portion also increased from 195 million to 228 million. This is not bad considering the fact that they did not make huge acquisition unlike UOB and DBS. One of the things I like about OCBC is that they are very prudent. So therefore, if you see their cost to income ratio is also lower than UOB, which is at 37.1%. But there's one thing that I didn't like when they are presenting their results. If you notice at the front, they mentioned that the CET1 ratio, which is a very important parameter on the bank's cash, they have put it at 16.2%. However, what they didn't show you is the drop in the post-final dividend from Q4 announced, which will actually cause a drop to 15.3%. But this is just a small issue as long as they continue to perform well. But OCBC also made one very big announcement in the earnings, and that is they will finally buy over their whole insurance arm, which is Great Eastern. Good thing is that it will increase the overall income and profitability of OCBC and definitely benefit shareholders with potentially higher dividend in the long run. OCBC also made another acquisition, which is PT Bank Commonwealth Indonesia, PTBC. It's quite a small bank considering that they have about 1.2 million customers in Indonesia. We will see as the integration takes place, although it might not make a difference, but it's still an expansion into the Indonesian market. If you like this video so far, please support the channel by hitting the like, subscribe, and comment on what you feel about the recent bank's earnings. Thank you, and let's continue with the video. Previously, I had a video on DBS earnings which you can see here. However, I did not manage to cover the DBS earnings call, which is another important aspect when it comes to analyzing a company. It gives you insight into the management view and any additional information based on the questions asked by analysts or investors. There are a lot of good things that we can get out of this earnings call. So if we look at this section, when an analyst asks with regards to the excess capitals that the DBS banks they have, their CEO has said that they are looking for ways to return the capitals because right now they are accreting a lot more capital than we are paying out. And that is obviously not sustainable. And this is something that is very amazing for our banks to say. Now, why is this so? It's because with the record profit, even with the higher dividend at a larger share base, the payout ratio is still at a low of 50% range. Because if you see at 1.536 billion of dividends declared, their profit at 2.956 billion will mean that the payout ratio is only at 51.9%. So if you see the sentence here, even with the enlarged share base, our payout ratio was still in the low 50% range. In order to return all the surplus capital, the payout needs to be much higher. At the same time, our policy is architectured on making sure that we can pay sustainably growing dividend over time. So this might be one of the hints that there might be possibility either a higher dividend or special dividend in the year end to come. With relations to the US interest rate, they are predicting a 2 rate cuts instead of a 5 rate cuts this year. This would definitely benefit banks in terms of the net interest income. Another positive note was that the CEO is actually surprised that the NPA did not go up higher even though the banks have actually built up their allowance reserves, because they were expecting that and that did not happen. This actually shows the resilience in the economy. So therefore, based on this earnings call, it has made me more optimistic with regards to DBS. And therefore, I've actually rose the expected dividend to slightly higher. That's why the yield now is at about 7%. Of course, even with the normal dividend, it's still at a very attractive dividend yield. Overall, the three banks had very decent results, with DBS of course being the standout of the three. With the potential growth in their non-interest income for all the three banks and stable interest rate, I expect this year for all three banks to continue doing well, and therefore may even continue to increase their dividends. Thank you so much for watching. I hope you enjoyed this video, and please hit the like, subscribe and comment on how you feel about the earnings for the banks. You can also watch my previous video where I introduced on the three banks and on the guide of analyzing basic REITs. Thank you, and I'll see you in the next video.